Thanks for tuning to today's Talking Point. I'm your host, Nirav Shah. It's always good to get in Nirav Sheth, but more so after they having finished the 3-day investor conference last week. A bunch of meetings that I'm sure happened between their clients and the companies that had come there. As I read the notes, I realized there was some record number of participation as well. So good to get a sense from him about what his thoughts were in terms of feedback that they would have received from clients as well as from corporates. Nirav, great having you. Thanks for taking the time out.
Thank you very much. Always a pleasure.
So, Nirav, what stood out from the 3 days of these plethora of meetings that you would have done?
Well, I think, Neeraj, I sense a big disconnect between what the corporates are saying and what the investors are saying. I mean, most of the companies I met, and this is across the spectrum of the capitalization with large, mid, small, fairly confident about the growth outlook. And I'm not talking about what's going to happen in the next quarter, but how they see their business prospects for the next several years. And I think broadly the investors are skeptical, right? And probably there's a context to the valuation. But my sense is that, I keep on telling this to my team that India will end up being something like what you've seen in Germany. There are a lot of niche companies, global leaders, and not necessarily dominated by very few large companies. I think the next 5 years, 10 years, you're likely to see India evolving in terms of having a very, very strong plethora of 300, 500 odd niche companies that can do very, very well at a global stage. And obviously there are too many levers to that, but I found companies to be very confident. Most of the companies are very sensible about capital allocation. Even something like banks, for example, I think that broadly most of them are looking at far better opportunities for credit growth. The India stack holds up very well. I don't think asset quality seems to be an issue. We are in a good space, Neeraj. Right place, right time, looks like it.
Well, that's music to the ears. Nirav, I'll probe each of these smaller nuances one by one. First, a broader question. You guys would be, as a house, pre-conference, constructive on a few pockets, not so constructive on some others. And you would have probably gotten companies from all these subsets. I'm trying to understand where is it that you or you plus the team uh, get a real positive surprise relative in terms of the commentary from these companies relative to the expectations that you have.
Well, I think in a way, this is a consensus opinion. So I'm not saying that, we are positively surprised, but the manufacturing renaissance, right? And we're talking about the hot topic right now, which is the electronic manufacturing systems or electronic manufacturing services. What growth rates they are talking about? I mean, most of the companies are looking at some 30, 40, 50% CAGR and 5 years out, 6 years out, right? And they're obviously working with a small base. So that's a very, very interesting space. And, and they've got very strong, healthy return ratios. I think outside that, the infra companies, the big surprise, so as to say, in the current year continues to be the government expenditure, which has been significantly pumping up the investment demand. Hotels, EPC companies, engineering companies, pump companies, banks, barring software. Let's keep it that way, barring software, where they continue to guide a cautious outlook, which is nothing different from what they've been guiding post their Q2 results. Broadly, people are enthusiastic, and I think that your economy reflects that, right? So your service PMI at 62.5, I have not seen it in the last 10 years, right? So the numbers at the ground level are, and so I'm saying the market is essentially discounting the robustness of the economy. And I'll make a point. I think we don't realize because we tend to see this daily, but you go back 10 years and then try and see, what were your numbers around current account deficit, what were your numbers around inflation, we are used to a CPI of 10%, right? So this is a big moderation that has happened. And, hats off to the way our economy has been managed. I, for once, was very disappointed with the kind of relief package we had in pandemic. And they nailed it right. Our inflation is lower than developed economies. We have not doled out money to the people, right? Which is obviously now we understand in hindsight is very, very inflationary. And we're still growing faster than anyone else, right? So, I mean, now it is highly possible that over the next few years, India could be current account neutral. I mean, I never dreamt of that. We are in this vicious circle of, a higher current account deficit, rupee depreciates, my inflation is higher, my rupee depreciates again, right? Just think of it. 10 years back, 15 years back, again, you had oil at $100, but your petrol diesel was 50 rupees a liter. Today, oil is still $100, and you got, petrol and diesel at 102, 105 rupees a liter. And it's not petrol, diesel, it's petrochemicals, man-made fibers. There's an entire crude chain. And we pay a price for that as an economy, right? So I think you have got a great chance in terms of resetting this, in terms of India with this 2-3% inflation, maybe a current account neutral, maybe steady rupee, and then this micro, right? The manufacturing, entrepreneurship. I'm very, very constructive on economy, very, very constructive on the markets.
Really good to know, Nirav. Let's talk about then the subsets based on your conversations with the companies in the conference as well, the feedback that you got and your own construct. Actually, I wanted to start off with the larger ones, but I'll start off with your answer. In your answer, you mentioned about CAD. You mentioned about the commentary that the EMS companies have given and the kind of growth that they may see. Now, Nirav, tell us, how do you think about this pocket in line of the fact that 2 points? One, there's now a large sector, 8-9 listed stocks, if I'm not wrong. But people tend to look at what they've done in the last 12 to 18 months to 24 months in terms of price movement. How do you, therefore, think of an investment case in these companies which are trading anywhere between 40 to 60, 70 times 1 year forward multiples and have rallied quite a lot already?
Yeah, so that's a very difficult question, but it is tough to make money, no? You cannot say that I'm very bullish on a particular thing and I want to buy it at 20 p. Life doesn't work that way. So the only way you can sense the risk or cut down the risk is by size of the bet, right? So I keep on telling this to my clients that if you believe that, the industry prospects are good, you are confident about the return ratios, if you're confident that my addressable market will keep on expanding, right? So what is happening? See, you need to put in context that when you got these small companies sitting at 80-90 Ps, they're working on margins of about 18-20% operating margins, net margin 6-7%. Those can go up over a period of time, right? They are now looking at EMS or whatever these PCB modules and all in a very small context in a small addressable market. So you can allow for the context that margins can go up. You can allow for the context that my addressable market can move up, stuff like that, right? So this is scenario building. And then you say that, okay, I'll probably put 300 basis points across 4 or 5 stocks. I think that, if you really want to buy India story, you need to have a very, very diversified portfolio. And this is not something which comes naturally to stock pickers, right? Because you want to bet your conviction in few stocks.
Precisely.
And Peter Lynch worked with 1,200 stocks while giving 29% compounding over 10 years, right? So instead of letting go of these opportunities which seem small cap and high valuations and all, do your bottom-up research. I'm not saying everything is going to play out, but I think there is a diverse opportunity in terms of investment options. Some of them are, in some cases, the valuation is out of the story. In some cases, story is out of the valuation. We live with that because that is market. No?
Where is the story ahead of the valuation, Nirav?
Let's say I think that in some of these infrastructure companies, right? I'll not go so much into company specific, or even in some of the utilities companies. I think there's big change that is going to come in this entire power chain, right? and people have not necessarily looked at it for decades now, right? Last time you've seen it was in 2008-9. Those opportunities are opening up, right? You've not set up a thermal plant for a long time, so that entire system has got washed out. And no matter how much renewables you do, you will have to set up thermal power plants. You will have to invest in distribution. You will have to invest in smart meters. So I think probably there is some amount of structural element that can play out over there. But yeah, to answer your question, I'm cognizant of the fact that markets are bullish, stocks have done well, and there are very few places where stories ahead of the valuation. In most of the cases, valuations are ahead of the story. But so be it. It's quite likely that markets could remain flattish for 6 months, and they could even correct. The point I keep on asking myself always is that, do I have enough things to buy so that in next 3 or 5 years I can get a compounding of 15-18%? I think those opportunities are available. I'll keep it at that.
Got it. Okay. So in effect, you made a very interesting point before this answer, which is that in themes like maybe EMS players or maybe some of the others, where the opportunity runway is very long, seemingly, and the growth rate seems strong, but the valuations are expensive, take a smaller bet. So get presence there, but take a smaller bet in case the valuation argument goes wrong at some point of time. That's
Absolutely. I'll give you an example. Now, and I'm not talking about the company specific, but it helps. Let's say, for example, Dixon is a casing. Now you can argue that the markets are irrational because they ended up getting this order from Xiaomi, and then the stock has rallied. But please appreciate the way I look at it is that all this while you were supplying to probably a Motorola and in bits and pieces to Samsung. Xiaomi is the third largest in the world, right? So that's a very strong, powerful customer acquisition. Now the question to ask is that, are you only going to assemble the phones for Xiaomi, or are you going to manufacture the camera modules, the audio modules, the PCB modules, and stuff like that? And then if you believe that this is not only for India, it is for the global markets. Now this is going to take time, but that is the point I was trying to make. That with one customer acquisition, right, your addressable market simply zooms out big time. Now, and therefore the markets have to price that in.
Sure. Okay, point well taken. Thanks. Nirav, how was the... so thanks for addressing both of those questions wonderfully. Lovely insights in the previous three answers. Now I want to take the conversation forward. How was the presence of healthcare companies in the conference? Because when I spoke to a few fund managers over the last few days, they talk about some bit of traction there, while there is price erosion, for example, in the US, but it is lower. And there was some conversation around how global pharmaceutical makers are telling Indian companies to set up manufacturing segments for them out here, wherein they are even willing to give the advance for the plants. My question is, are you guys constructive healthcare, all the facets? What is the feedback that you got from the conference?
To be very honest, I think we had a few representatives from pharma company. My lead pharma is yet to onboard. There is a big demand supply gap for the analyst. You are aware of that. So the way I essentially look at it, first of all, I am disappointed that, and India, we are good in terms of intellectual capabilities. Now that ecosystem has built out very well, right? But I think in last 23-24 years, we've got one NCE molecule, right? Which is where bulk of your valuation is being created. If you now know about this, the weight loss drug, that has gone bonkers. So I think we are still sort of process oriented in that space. And till that time, I think that you are running on a treadmill. So broadly, if you look at it, most of the companies tend to peak out at about $1.5 billion of generic sales, because then you are running down your existing portfolio, and to keep that, you keep on onboarding new ANDAs and stuff like that. It's fairly bottom up, and therefore I will not comment too much into it because I'm not necessarily an expert into individual companies. But if I have to play India now, I am not going to look at a pharma company or a pharma sector right now, or let's say, for example, a 50 times, 60 times valuation that my consumer companies are trading. Uh, I think the India that plays out in the next decade will be different than what has played out in the last decade. That I'm pretty sure of. I may be wrong, is a different question altogether.
Fair call. I read some interesting comments around cement, Nirav, from the notes that I got from your team. And one of the companies tried to raise prices and was not able to sustain that and had to roll back prices. But at the same time, most companies are looking at capacity expansion and consolidation in a meaningful way. How constructive or not constructive are you on cement, and why?
We fairly like the space, so it has surprised us, right? And I think it's probably surprised most of the participants, because I think quarter one volume growth rates are close to about 18%, and that comes on the back of very strong FY23 itself, right? So we have not seen this kind of double-digit volume growth rate for a long time. So the way we look at it is that this year it is likely to be a volume growth rate story, and no one tries to be very heroic in terms of taking price increases ahead of elections. But next year, that gives an extra lever, because next year you have got an opportunity to try and increase the prices. My sense is that I believe that I think that the analysis is slightly behind the curve in terms of looking at the long-term growth rate in cement. I suspect that, see, something like infrastructure momentum, it takes a hell lot of time to build up momentum, but it takes a hell lot of time for that momentum to come off. These are 5-6 years gestation projects. They happen after a lot of policy changes and all, and it takes a lot of time to kick that up, right? But once that happens, once the template is set, right, it continues for a long period of time. So I think that infrastructure is going to the story. Now you may not have too many direct plays on that, but I'm saying, I'm talking about, Vande Bharat. It takes time to get first few trains on the track. They're talking about 400 trains in the next 2 years. These are big changes. The railway tracks, the spending on defense and stuff like that. Airports, the number of airports. I'm told that it's very likely that, the Navi Mumbai airport, I'm told that 80% of the work is done with. So this is all what is reflecting in your cement growth rate, not necessarily only real estate.
Got it. Now, before we actually move on to the other pocket, which is banks, and I want to wrap up the conversation with that. But just before that, since you mentioned trains, it's a sector that was in the doldrums for a really long time. The last 18 months or 24 months have been music to their ears as well, right? And the markets have rewarded these stocks meaningfully, not just in the fact that they've rallied, but they're trading at premium valuations, Nirav, currently. Now, I would love to understand how you think about this again. Is it again related to the sizing of the bet? Because the valuations are premium, but the book-to-bill ratios are very healthy, and they're talking about getting into multiple newer segments. How do you play this segment?
Same thing is no different. I completely agree. So I was in Calcutta before my conference, and I ended up meeting some of these companies like Titagar Wagon and Jupiter Wagon and all. So obviously, first of all, again, you need to give credit to what is happening. It's a shame that you are importing wheels all throughout for the last 50 years, right? And I don't think that great technology is required to manufacture wheels. We put Chandrayaan in moon at a cost of, I'm told, about 600 crores, right? What the hell? You can, of course, manufacture wheels. Now, the question is that the government is smart enough to say that, okay, I'm giving you a 20-year contract, right? Because there is upfront capex that goes, and I'll take care only of a 40% odd capacity, right? So I'm not going to pay you off for 100%, right? And then it's your job to try and increase the capacity to 80% by roping in orders from the private sector or exports or whatever it is. So that's a big thing, right? So I think that it's not only about wagons. So if you look at any of these companies, all of them are so deepening of manufacturing. That's the right word, right? So they want to get into propulsion systems, they want to get into braking systems and stuff like that. And like I said, all these things take time. But this is no longer just a blueprint. This is something that is happening on the ground, Neeraj. And markets are efficient. Let me keep it that way.
Okay, so sizing of the bet is the best way to do it.
Absolutely.
Is what you would like. Okay, my final question, Nirav, and that's on banks. Now, I must give credit where it's due, Nirav. Sometime around the COVID time, You came and you said in this interview that, Neeraj, if you're looking for a big call, here's my big call. PSU banks will do well. Now, just last week, Dr. Sikananan wrote in his weekly column on us on this thing, and which is where I got to know that since November 2020, a clutch of PSU banks index has actually done much better than the private banking space, right? And that was an eye opener for me. That's not a 6-month phenomenon; it's a 3-year phenomenon. I want to understand from you, what do you think is ailing some of the private banks currently? Because their commentary around credit growth, their commentary around, and if you believe that the economy is to grow, credit has to grow per se. So what is it that is not working, and can that change in the times to come?
So I'll not say it is not working. I think that, what, and all of us, I'm not trying to be, I'm not saying that I'm an expert. I think we need to account for the fact that people tend to get better over time, right? So you have to assume that what was ailing PSU banks at some point of time, there's a market feedback that comes continuously, right? So, and obviously, just think of it. The private sectors did very well at the expense of PSU banks.
Yes.
I'm talking about pre-COVID, right? So, therefore, if you look at the share of the profit, let's say there's an X profit pool, and if you look at the share of the profits of private, that would be 80-90%, somewhere thereabouts. Now, that has sort of reverted back to me, right? But the fact of the matter is that a lot of these banks have started doing well. They've understood how to do retail banking. Retail banking, by definition, is more granular and therefore less risky. But to me, I think that we need to appreciate that the biggest building blocks, and which is why I'm not necessarily worried about the asset cycle, right? So people who in the market long enough tend to get skeptical and we are at the peak of a very good asset cycle, and then we'll have rate losses picking up and all. Things don't happen just like that, right? They happen. So the point is that your framework of CIBIL, the account aggregators and stuff like that, your KYC norms, they're very, very solid, right? Today, a bank underwriting a risk for any retail guy knows exactly what is the level of debt sitting on that guy, right? You know exactly what is the repayment capability. Now, for that guy to default, two things have to happen. A is a fraud, right? But then let's say that's a very, very long tail, and you will have few cases always is a fraud. Or secondly, the guy has to lose a job. If I don't have an income, I cannot pay up. So I don't see anything on the horizon. What will happen though, and what I'm keeping my eyes on, is that as my credit loss keep on tapering off, the markets will reprice the risk. They will try and appreciate the fact that my historical credit loss are 2%. My experience of the last 5 years tells me in a new setup, it is about 1%, and therefore my NIMs can come down. That is a part of growing up, right? So you become more competitive, and those competitions will eventually, that spread will get competitive. That is the way it's going to happen. But just because, I've got very great asset quality and therefore it has to increase, I'm not a big buyer of that. So I'm not a great buyer of this reversion to mean theory everywhere.
Okay. So in which case, Nirav, just before we wrap up, are you therefore, based on the commentary that you received in the conference, which is of credit growth, so on and so forth, but this argument that you make currently as well, is it prudent to invest into some of the private banks? Some of them have gone nowhere in the last 12 months, right? We know the few names as well, which quite haven't participated despite being the darlings pre-COVID per se. Are they good investment candidates, or there are better things elsewhere?
No, of course. So I think that banks will remain a very, very dominant part of the investment portfolio for a long time. And I believe that it is time to start looking at private sector banks as well, including the larger ones, right? I think that is probably one of the sectors where the valuations are below the pre-COVID levels, and given where the market valuations are. And I think that market is too focused about peak names and, whatever the lowest credit cost, and inherently skeptical about what could happen in the next 1 or 2 quarters. At one point of time, I believe that, you'll have very strong returns in a very short period of time.
Got it. Nirav, awesome talking to you today as well. As is the case,
Likewise.
Always, thanks for taking the time out.
Thank you.
And viewers, thanks for tuning into this edition of The Talking Point.